What is ETF? An ETF, exchange-traded fund, is a type of investment fund that trades on an exchange, much like a stock. ETFs are designed to track the performance of a particular index, such as the S&P 500, or a specific sector, such as technology or healthcare. ETFs are typically made up of a basket of underlying assets, such as stocks, bonds, or commodities. The fund manager of an ETF will buy and sell these underlying assets to maintain the desired composition of the ETF. This allows investors to gain exposure to a diverse range of assets with a single investment, rather than having to purchase each individual asset separately. ETFs are popular among investors for several reasons. They offer low fees and expenses compared to traditional mutual funds, making them a cost-effective investment option. They also provide greater flexibility, as they can be bought and sold on an exchange throughout the day, whereas mutual funds are priced only once per day after the markets close. There are many different types of ETFs, including 1. Equity ETFs. These track the performance of a particular stock index, such as the S&P 500 or the Nasdaq. 2. Bond ETFs. These track the performance of a particular bond index, such as the Barclays Aggregate Bond Index. 3. Sector ETFs. These track the performance of a specific sector, such as technology or healthcare. 4. Commodity ETFs. These track the performance of a particular commodity, such as gold or oil. 5. Currency ETFs. These track the performance of a particular currency, such as the euro or the Japanese yen. Overall, ETFs provide investors with a simple and cost-effective way to gain exposure to a diversified range of assets. However, it's important to carefully consider the risks and benefits of any investment before making a decision to invest. Difference between mutual funds and ETF? Mutual funds and ETFs, exchange-traded funds, are both types of investment funds that pool money from many investors to invest in a diversified portfolio of assets. However, there are several key differences between the two. 1. Trading. Mutual funds are traded once per day after the markets close, at a price calculated based on the net asset value, NAV, of the fund. ETFs, on the other hand, trade throughout the day on an exchange, like individual stocks, and their prices fluctuate based on market demand and supply. 2. Fees. ETFs typically have lower expense ratios than mutual funds. While mutual funds are managed by professional fund managers, who research and select the underlying assets, ETFs are generally designed to track an existing index, which reduces the costs associated with active management. 3. Minimum investment. Mutual funds often have higher minimum investment requirements than ETFs, which can be bought in smaller quantities. 4. Transparency. Mutual funds must disclose their holdings on a quarterly basis, while ETFs are required to disclose their holdings on a daily basis. This means that ETF investors have more up-to-date information on the assets held by the fund. 5. Tax efficiency. ETFs are generally considered to be more tax efficient than mutual funds. This is because ETFs are structured in a way that allows them to minimize capital gains taxes when the underlying assets are bought or sold. In summary, while both mutual funds and ETFs offer investors a way to diversify their portfolios, ETFs have some advantages in terms of trading flexibility, lower fees, lower minimum investment requirements, and greater transparency, while mutual funds may be preferred by investors who value active management by a professional fund manager. Which one is easy to invest, mutual fund or ETF? Both mutual funds and ETFs offer investors a relatively easy way to invest in a diversified portfolio of assets, but there are some differences in terms of the ease of investment. Mutual funds typically require investors to open an account with a fund company or a brokerage firm, fill out an application form, and provide the minimum investment amount. After that, the investor can simply choose a mutual fund that meets their investment goals and risk tolerance, and make an investment by purchasing shares at the end of the trading day. Mutual funds also offer automatic investment plans, which allow investors to invest a fixed amount of money at regular intervals, such as monthly. ETFs, on the other hand, are bought and sold like individual stocks on an exchange, which means investors need to have a brokerage account to buy or sell shares. This process may require more steps than buying mutual funds, such as setting up a brokerage account, placing an order through the brokerage platform, and paying brokerage fees. However, once an investor has set up a brokerage account, buying and selling ETFs can be done quickly and easily. Overall, while mutual funds may have a simpler investment process, ETFs can also be easy to invest in once an investor has set up a brokerage account. The choice between the two will depend on an investor's preferences and investment goals. Which one is more profitable, mutual funds or ETF? There is no simple answer to whether mutual funds or ETFs, exchange-traded funds, are more profitable, as both investment options can generate returns for investors. But the returns will depend on several factors, such as the investment strategy, asset allocation, fees, and market conditions. In general, both mutual funds and ETFs can offer a range of investment strategies, such as investing in stocks, bonds, commodities, or other assets, and can generate returns based on the performance of the underlying assets. However, the returns will depend on the skill of the fund manager or the performance of the index that the ETF tracks. In terms of fees, ETFs generally have lower expense ratios than mutual funds, which can have a positive impact on returns over the long term. However, other costs, such as brokerage fees and bid-ask spreads, can also affect the overall profitability of an ETF investment. The profitability of mutual funds and ETFs can also be influenced by market conditions, such as the overall direction of the stock market, interest rates, and geopolitical events. While past performance is not a guarantee of future results, it is important for investors to consider the historical returns of a mutual fund or ETF before making an investment decision. In summary, the profitability of mutual funds and ETFs will depend on a variety of factors, and it is important for investors to carefully consider their investment goals, risk tolerance, fees, and other factors before making an investment decision. It is also important to remember that investing always involves risk and that past performance is not a guarantee of future results. When can you start investing in ETF? You can start investing in ETFs, exchange-traded funds, as soon as you have the necessary funds to do so and have opened a brokerage account with a reputable brokerage firm that offers access to ETFs. Most brokerage firms have no minimum investment requirements for ETFs, so you can start investing with a small amount of money. However, keep in mind that ETFs, like any other investment, carry risks, and it's important to understand the potential risks and rewards before investing. Before investing in ETFs, it's a good idea to do some research and educate yourself on the different types of ETFs, the risks associated with investing in them, and the fees involved. You may also want to consult with a financial advisor who can help you determine which ETFs are best suited to your investment goals and risk tolerance. Strategy to invest in ETF? There is no one-size-fits-all strategy for investing in ETFs, exchange-traded funds, as the best strategy for you will depend on your individual financial goals, risk tolerance, and investment time horizon. However, here are some general strategies that may be useful. 1. Determine your investment goals. Before investing in ETFs, it's important to determine your investment goals, such as whether you're investing for the long term or short term, what level of risk you're comfortable with, and how much you can afford to invest. 2. Diversify your portfolio. ETFs can help you diversify your portfolio, which can help you reduce your risk exposure. Consider investing in a mix of different ETFs that track different asset classes, such as stocks, bonds, and commodities. 3. Consider your investment time horizon. If you have a long investment time horizon, you may be able to afford to take more risks. Whereas if you have a shorter investment time horizon, you may want to focus on less risky ETFs. 4. Keep an eye on fees. ETFs typically have lower fees than mutual funds, but it's still important to pay attention to the fees associated with investing in ETFs. Look for ETFs with low expense ratios and transaction fees. 5. Rebalance your portfolio periodically. As the market changes, your portfolio may become unbalanced. Consider rebalancing your portfolio periodically to ensure that your investment allocation remains in line with your investment goals and risk tolerance. 6. Consider tax implications. ETFs can have different tax implications depending on the type of ETF and how long you hold it. Consider consulting with a tax professional to determine the best tax strategy for your ETF investments.